All right. What an interesting week we had here. Um,
pretty much pretty much went from pricing in not enough cuts to now pricing in too many cuts. Almost two cuts per meeting for the next two meetings. Do you think that's too
yeah.
much, or is that something that you're actually on board with?
Well, I think that it really comes down to how the data progresses from here. Specifically, we have another jobs report in the next month or so before the Fed meeting that we're going to see really where the direction of labor is going, and I think that'll be more of a cementing factor in the forward rate markets for what we're seeing here. But I do think, we're already at negative 200 basis points over the next 7 meetings. So that's pretty aggressive, right? Like that's, again, a cut at every meeting and possibly two cuts at 2 meetings back to back, right?
Yeah.
Um, so that's pretty aggressive there. And now that this may come off as me saying like, okay, we need less cuts. And in reality, it's an interesting dynamic because I don't think we need less cuts, but I do think that we should have started cutting already. And I think that that's where it's really important that we understand like what is going on here, because I think that in terms of, let's just say, the forward path of where the Fed's going is it comes down to the direction and the speed at which the Fed is cutting, right? Or I should say the speed and the timing, or maybe they're one and the same. But ultimately, the direction being where they end up. And I think that right now the market's pricing the Fed to bottom out just above 3% as of the latest close, and then lift off from there in the next hiking cycle way down the road. The problem with this is the market's essentially pricing in a soft landing, right? Because in a recession, we're at 5.25 right now. To think that if the market was figuring a recession into the calculations, that the Fed would be bottoming above 3%, which is well above the 2018 peak at which they peaked and then started cutting, just for context, I think is a little aggressive, right? That obviously the market's not thinking there's a recession.
Yeah.
So I I think that at a little bit over 3, the market's expecting a soft landing, and this obviously impacts the bond. So I kind of want to go back to just what we were talking about a few minutes ago here, a moment ago with the implied cuts. 200 basis points of cuts is a bit aggressive. Now, we essentially can run into a situation where we end up with more than 200 basis points of cuts over the cutting cycle, but we have to cut the cuts back first. And what I mean by that is all it's going to take is a mediocre or not as soft, not as cold job report at the next meeting, at the next job announcement, and the cuts are going to get pulled back in the next job report, right?
Yeah.
If that comes in just not even as cold as the last one, let's just say you see 4.2, right, instead of 4.3 or anything above 4.3, I think automatically the curve gets slapped a little bit in terms, and bonds get slopped a little bit, and you see this reaction of the Fed bringing cuts out, or the market bringing Fed cuts out of the market. Ultimately, though, I think we're going to see 200 basis points of cuts in the cycle, unless, of course, we get a soft landing, which it isn't the base case, but it's the case at hand right now. That's what the market's expecting.
Well,
So,
isn't it
if
pricing in a soft landing right now? So that 200 basis points is still the soft landing price.
correct, yeah, that's the market price. If it was a hard landing, the market wouldn't be pricing in 200 basis points. But here's the caveat, right? If the market is pricing in the recession, the alpha's already gone, because at that point, bonds are through the roof. Fed funds futures are absolutely pancaked, right? Like there's no there the trade has to be made in anticipation of. Essentially, you have to be riding the waves into the max pricing, not waiting for the pricing to occur, right? That's how the alpha is made in the market. It's taking a segment of the market, let's just say interest rates, saying they're mispriced, and you buy, and then it reprices, and either you make money or lose money. So I think that kind of opens the door for a little bit of this. efficient market hypothesis, right? Like, is our markets really efficient? And I think the reason that that's such a great debate is because they are and they're not. They are today. The markets are efficient today. They account for everything today, right? For
Yeah.
example, if there's terrible news on a stock, it's going to go down, right? Today. It's going to reprice today as it happens. But, in the future, the they're usually things are discounted or priced to or at a premium, and that is where they become inefficient, right? To think that, for example, the Fed was going to cut six, excuse me, there was going to be six rate cuts in 2024 at the end of 2023. That was a huge inefficiency over the long term, but the market was efficiently pricing that in what people were expecting at the time, right? So that's how you kind of have to look at it. So ultimately, I think that we're in a position now where the Fed's going to start easing, and the door is now open to how much they will end up easing. And I kind of like to go with the over rather than the under, given where we are in the cycle. But that is for a different discussion. Let's actually go into the Nasdaq, and there's some pretty interesting. There's some extreme discomfort. I don't even guess we could say pain, right, in the
Yeah, a lot
Nasdaq
of
at the
pain.
moment.
I
A
mean,
lot of pain.
not for us, thankfully, but um, yeah, this is not the dip to be buying. We've had quite a few dips in the history of this podcast where we were advocating to buy the dip. This one I don't think is the dip to buy. This really doesn't feel like it.
Now, you let's actually talk about why the market's dipping, because I think a lot of people are confused. I don't want to use the wrong word, but I think confused is the one to be using here in terms of why the market's down. Everyone's pointing the finger and putting the blame on Japan here for the carry trade unwind, right? And I think that's it's a little bit of a stretch.
Do you want to
I
just
think that
quickly give a quick rundown for those that don't know?
ultimately what happened is Japan, well, it's been this carry trade is a phenomenon with Japan that's pretty much gone on for decades now, and it ultimately stems from this: Japan having much lower interest rates, even negative interest rates compared to the rest of the world. So what you could do essentially is you could borrow money pretty much at negative rates or zero, right? And then you can fund other investments with that money. And that's you're basically borrowing money for free, investing it, and then paying back the money that you borrowed, little to no interest, keep the gains. It's basically a leverage with free. It's like a margin in the stock account with zero interest, right? So obviously, it's seen as basically like a global liquidity source. You could pull liquidity from that, and you can fund things if it's buying tech, parking money in money market funds, for example. You could borrow 1 million yen at zero, convert it to US dollars, put it into a US dollar money market account, hypothetically, right? And then you're getting paid 5%, and your interest on the other side is zero. That's the carry trade in a nutshell, right? And ultimately, Japan raised interest rates more than expected a few weeks ago, and that basically slapped the carry trade. And we can look at that by looking at the U.S. dollar Japanese yen pair. And what you'll notice is it started falling in mid July, and really just accelerated from there, and then it really imploded once the rate hike happened. Now we're down here. The yen's gotten significantly stronger from the peak compared to where it has the type of move that it has been doing, complete reversal, right? We're back to pretty much it's racing the entire move of 2024 in this leg down. So that's a very strong reversal. Now, everyone's saying, oh, great. That liquidity source being the carry is getting chopped up. So Japan's essentially driving down equity prices. And most people, what they'll do, very linear analysis, they'll add the Qs or whatever they want on top of this, and they'll say, look, and we'll turn this off to make it clean, right? So you guys can see if you're watching. Really simple. Qs peak when the US dollar yen spread peaks, and then from there, the pair drops and the Qs drop too. And it's almost in lockstep correlation, right, from the peak. So people are like, oh, great. The yen is causing the collapse of the U.S. markets. And now I think that's a little bit of a stretch, because if we go back to our our basic approach to the markets and our understanding of our basically of our risk models, right? We understand that there's obviously more to play in the market than just the yen. The yen's not the sole driver. And ultimately, our model, if you go back into the quant tech and you look, you'll see that it started weakening. Our growth, our growth component in our model started weakening in the back half of the second quarter, right? So think April on, starts weakening, right? And it eventually actually goes risk off in the beginning of July, call it July 2nd, right? That's when the model really flipped. Now, if we look at July 2nd, which was essentially right here, I'm not, see, this is where people get confused when like we're not out of the markets or out of equities because of the carry trade. The carry trade just happened to unwind as risk pivoted off. And what you need to understand is usually these types of risk off things happen in risk off regimes, right? So risk off things tend to happen in times of risk off environments. So just because this yen carry trade happened, that doesn't necessarily mean the system saw it coming. We were so like aware of what's going on with Japan. Obviously, this unwind caught everyone by surprise, but it happened to occur in a risk-off regime, so it amplifies the current risk-off environment that's already been taking place for well over 2 weeks before this thing even started unwinding, right?
Yeah, I think
And
that's
I
a good way to put it. Like, good way to put how our system works. It picks out what environment we are in, and in these environments, the odds of good things happening or bad things happening, depending on the regime, are elevated. And we just pick that side of the trade. That's pretty much how the system works. It starts seeing weakness. It it doesn't know that something's going to happen. Like, for example, COVID. COVID happened during a risk off regime as well with our system. And it's not like our system knew that COVID was going to happen. But going into it, we were in a deflationary environment, and that just kind of breeds things that happen that become risk off and go further into risk off. It's very momentum based. The whole economy is very momentum based. That's why when you see companies like Amazon and Apple, like, they're doing well, and they're going to continue to do well until they hit a wall, the momentum shifts, and then they do poorly, and they continue to do poorly until they're able to shift that momentum. And that's just how the economy functions, and that's how our system functions as well. But obviously, COVID, that was an anomaly. That's not really a momentum based thing. But
yeah, no, yeah.
going into that, we were risk off. And I'm sure if COVID didn't happen, something else would have happened because we were in deflation going into that.
Yeah. So I think that's a again good summary there. But let's we started this conversation out talking about interest rates, right? And what we expect the Fed to be doing in the short term. I personally think that it's going to take a lot to spook the Fed into making their first drop a 50 basis points drop, right? I think that there's going to have to be some really detrimental data that comes out, meaning like, maybe the next unemployment print is 4.5. You know what I mean? Like, I don't think the Fed's going to just come in with a 50 basis point clip to start the show here. But crazier things have happened. Ultimately, I think there's going to be some curve repricing here. What's going to happen is some cuts are going to have to get taken out of the market, like we said earlier. That's necessarily not that bullish for bonds in the shortest time frame. Think about the next month or two, right? Now, could this take be wrong and bonds continue to rip? Absolutely. I mean, we're positioned since July 2nd, pretty much this candle right here on the chart. Essentially, we're positioned from in TLT at about 90, right? So TLT is 96. So there's a lot of stuff that has to go wrong here for us to even get back to our cost. But I think that there is a good shot that bonds should consolidate here as you potentially pull out a cut or pull off two cuts off the table, and the market reprices for a softening, but not softening and accelerating, right? Or softening and softening further, I should say, environment. And in that environment, cuts get taken off the table. bonds consolidate, and the data continues to come in. Ideally, it still comes in soft, and then they ramp up from there, and then you get back into the phase where once the Fed starts, that floor we were looking at earlier. The idea is, if you look at bonds today, bonds are basically telling you, again, go back to that alpha outlook. Bonds are at 90, TLT at 95, 96 is under the assumption that the Fed floor is about 3%. If the Fed floor is higher than 3%, meaning they cut less and they bottom out much higher than 3%, TLT is going to have to get repriced lower. TLT gets repriced higher from here if this floor is lower. So then the basic assumption is, do you think the economy is going to continue to soften? And do you think the Fed's going to have to do more? That's where our models come into play, and they will continue to guide us in that direction and on the speed of which things happen, and we will take that from there. But I want to hop back to equities because I know a lot of you guys are wondering, like, again, the state of equities is pretty poor at the moment. We're recording this as of 7:37 p.m. Eastern time, and the NASDAQ is already down another 1% in aftermarket trading. So this obviously could reverse by the open, could bounce, but not a good look, especially after rejecting off of Momo. So what's really going on here now in what's going through my head, and Artie, maybe you have something different, but I think that we're setting up here for a possible shift to bearish trend.
Well, yeah, I mean, we're under Momo, so that's the next indication that's going to be happening is a shift to bearish trend, and bearish trends tend to lead to lower prices. That's
Right.
why this is not a dip I'm buying. That
Yeah.
and the
Yeah.
regime. This is really not the kind of dip that you'd want to be buying, and volatility is going to be elevated as well along with that.
True. Okay. Yeah. That's a good way to put it. Now, I think the biggest line in the sand for me is the fact that, the Qs can't get above Momo, right? And even if you look at SPY, I know some people are like, oh, the Qs aren't the benchmark. Okay. Well, here's SPY, right? After hours under Momo as well, actually closed below Momo. So you have both S&P 500 and NASDAQ under Momo. This is not what you want to see. They need to reclaim Momo to the upside as soon as possible, save the trend if equities are going to rotate higher. If not, what ends up happening is the trend flips, goes bearish, and becomes the new line in the sand. Anything below this is going to be bearish, and we're going to roll over, and prices are going to continue to go lower. So that's how this is going to play out, in my opinion, unless we can get back above Momo. And with that being said, the main driver, again, for this unwind, I don't believe to be the yen. If you look at commodities started weakening at the beginning of July as well. Commodities are not a carry trade. You don't borrow yen to buy commodities, right? So in that sense, this unwind here in commodities, again, just happens to have happened with the yen going down and the market going down. More importantly, it is not just going down, right? What's happening here is you're seeing a demand hit. And I think the market's picking up on this. I think the market is thinking that there might be a possible shock or surprise in growth, if it's downward revisions or if it's GDP decelerating, whatever it may be in the next quarter. Right now it looks strong. GDP now looks strong, but we're still very early in the quarter. I think the market might be a little bit spooked there with commodities down. Obviously, market's down. Our system has been risk off. And I think that's what you said earlier in the podcast, Artie. This is one of those dips, right? Where things are not the same. Like back in April, we were you can go back to the podcast. We were gung ho. We were literally slamming Twitter saying, these are the dips that you want to be bull posting and buying. Like, more buying, less crying.
We did get a lot of shit for that too. It's funny how that works.
Yeah.
We got a lot of
Yeah.
shit for that, and then the whole time we were riding equities up, we got a lot of shit from bears saying it's going to crash any second. And then
It's funny how that works.
Then we caught the crash. So we're just too good. We're too good.
All right. Calm down there. Calm down.
I mean,
but all in all,
I do fear our luck is going to run out. But I mean, the system we built is pretty damn good.
Yeah, and I don't want to say I don't want to say luck, right? I know there's a degree of luck and finesse in this game, but I do think there's a degree of cyclicalness or cyclicality, right, behind this whole thing. So, for example, you get into an environment where you're risk on and everything's going up, easy to ride the wave. The pivots are usually the hardest, but eventually you get caught in a fake out every now and then. Could this be a fake out? And there are a good amount of fake outs in the system, not overwhelming over the last since the 1990s, but there are some that you have to be aware of. Look, it's going to happen, right? There's no perfect system. I'll be the
Yeah.
first one to tell you, right? So, could this be a fake out? It's possible. But if we were to treat every pivot like a possible fake out, you would have no balls.
Yeah,
You would have no
exactly.
conviction,
You gotta have
right?
that conviction.
So to have that conviction means you have to be trusting the system. And if it stabs you in the back every now and then, okay, so be it. The odds are in your favor, or at least they have been in our favor, to trust more than we doubt. And that's how we execute, right? We worry less, trade more with size, with conviction, and walk away. That's it. We have no fear. If the regime flips back risk on, guess what? We're going back risk on. No ifs, ands, or buts. We're gonna buy in, right? Just that's how this works. But until we get that confirmation, we are in a risk off regime and assets should react accordingly. Now, commodities, like I was saying earlier, I think that there's an initial growth hit here. And I think that starting in July, really, that unwind really helped push equities lower.
Yeah, I think
If commodity,
the next level that we're looking for is breaking down the lows that we saw at the start of the year. That's really what's, I think, going to get us to that hard landing scenario if demand really gets crushed that hard. And we are in bearish trends, so that's a very high possibility.
yeah, for sure. So like obviously that speaking of the trend, right? A lot of people I put this trend line and draw this on the chart. Because I know a lot of people don't have DDAP, meaning they're looking at a chart that just essentially is pretty bare, right? So I want to make a general path here of what people can see. Obviously, we have a sharper tool where we can catch trends a little sooner and navigate that way. And ultimately, we've been bearish trend here since the 23rd of July. So commodities have been falling apart pretty much ever since. And we took out the traditional trend line that I drew in here that started at the middle of last year. Now we're under that trend line. We're bearish trend. So the question is, do we reclaim the trend line, go back up to Momo, reclaim that, go bullish trend, right? There's a lot of hurdles here to the upside. The downside's a little bit smoother in terms of, we take out Monday's low at some point, and then we can go down to the December 23 low, and then maybe even the May 23 low. At that point, I think you really have to be worrying about a recession because commodities don't fall apart when the market's booming. Realistically, they don't. All right. So now they can chop for sure, but if they fall apart, you're going to get really accelerated disinflation. And I think that, we should talk about what's coming up next year in the week in terms of like actionable stuff because you're not going to be able to do much with there's no CPI this week or anything like that. So in terms of commodities, weaker right now, just watch and see if they can fail a bounce. I should say if they can hold a bounce or if they fail and they reverse. I think this will be a key driver for equities. If they start reversing and going down, I think it's going to drag equities down with them. But obviously on Thursday, as you guys know, this is recorded on Wednesday. Thursday, we have continuing claims, jobless claims. This is going to be a bond driver. This is going to be something will happen to bonds because of this, in my opinion. Maybe they go up, maybe they get slapped a little bit, depending on what the print is. Obviously, we're not here to trade the prints. We're here to trade the cycle. So how this plays out, I think, is we should see continued easing or softness in the jobs market, or I should say, rising unemployment claims steady. Right. If these accelerate significantly, you're going to have bonds really rip. If they cool significantly, you're going to have bonds really dip. So that's how we should be looking at this. We'll see what this prints tomorrow at 8:30 Eastern in the morning. And finally, I want to touch over two things. One being the note auction. Someone asked us in the Discord in our members area, what is the note, like what's the most important things to watch in the note auctions, and why, or to focus on, I should say, and how to interpret them. So the most important things to watch typically are what's tweeted out or what's slammed out on the internet once the auction takes place, which is typically these quick data points. Bid to covers, high yields, the awards, and then who's taking what. This is typically like the most important stuff from the auctions. Now, what you should really be focusing on is two things: how much the dealers are taking, and what the high yield versus when issued yield is. The WI means when issued. If the high yield is above the when issued yield, what that's essentially telling you is the when issued is the yield before the auction takes place. What this is essentially telling you is that there's not enough demand for bonds, so bonds actually have to, or the yields have to rise above where they are in the market in the auction to fill the auction. Meaning, the market yields at the beginning of the auction were not sufficient enough to complete the auction, and this is considered a tail. When the high yield is below the market yield, it's considered trading through, and at that point, you have a situation where there's actually more demand for the bonds than there were for yields than what the market was offering before the auction. So typically, when they trade above, when the high yield trades above the when issued, it's not a good sign. When the high yield trades below the when issued, it's a good sign. That means there's demand. So one is above, little or less demand, below, more demand. That's really all you have to know. And then the primary dealers, how much they take. The bigger the number here means the less the rest of the market is absorbing. So the bigger the primary dealer number is, that means that there's a smaller or lower demand at the auction. That's really all I have to worry about with these auctions. They're not that complicated, but I do want to say, ultimately, for U.S. Treasuries, they're irrelevant. They're actually irrelevant, because you're going to trade with a tail, you're going to trade through, and people are going to say, if you trade with a tail and the trade's weak, people are going to say, oh, there's no demand. Like on X today, horrible auction, horrible Treasury auction. Everybody's like, oh, horrible auction. Okay. Yeah, the auction's so horrible. Bonds are what, down 70 basis points? Yes, I know, so horrible, right? Like, over the long term, it's kind of like the QRA. It matters on the day. It matters when it happens. 2 days from now, nobody's going to give a crap. Okay? Especially in the Treasury market. Now, if you're talking about a third world country or an emerging market, and their Treasury or their government starts absolutely dumping bonds on the market, yeah, you have a problem. But we're talking about the United States of America here, U.S. Treasuries for the time being, world reserve currency, world reserve central bank. You do not have to worry about a 3 basis point tail. Okay, or the 3 basis points, surprise or weak demand in Treasury auctions. Ultimately, the long end absolutely, if you look at bonds, they absolutely rallied. And I don't want to use TLT. I'll correct myself. If we look at the 7 to 10 year, it was down 36 basis points today. So the duration was 10-year notes. They weren't 30 years. So it was down 36 basis points. I know someone's going to be like, oh, they're not the same, but okay, you get the point. A little bit of a hiccup there, but look at the absolute run here. If it was horrible, like if the bond situation was horrible, we should see this way down, not 36 basis points down, right? So you have to take this into consideration when people talk about these things in the markets. They like to blow things out of proportion. The auctions are not that important, just like the QRA, not significantly important either. So once you get that under control, you kind of just mellow through it. A little shock here, a little rip there. That's how this works. But the overall importance here is to stay glued to the cycle. Okay, one Treasury auction is not going to determine if the bond trade works out or not. So that's how you kind of have to anchor yourself. And before we sign off on this podcast, I want to cover this this idea that growth is super resilient at the moment. And I think this is a good, I'm sure you've seen these growth comments on the internet, like real GDP, high twos, everything's going well, right? And I think that you need to take a second and understand that inflation tends to fall faster than growth. Okay. So if you have think about growth from a nominal perspective, take inflation out of it. So we're looking at nominal, not real. Real is inflation adjusted growth, nominal. If nominal comes down, let's just say from 5 to 4.75, etc., right? It drops. but inflation drops faster. Real GDP is going to expand, even though nominal growth and inflation are both falling, right? So this is a dynamic. I'm not saying that that's happening at the moment, but you have, based on what GDP is pricing in, real GDP is pricing in now for the third quarter, they're pricing in nominal to come down. The thing is inflation's priced to come in down much more. So real GDP goes up, right? So I think that it's something we have to keep an eye on. These types of cycles don't happen in a couple of months. It's a multi-month process. How it plays out, how we ride it out. We were just in a risk-on regime for how many months now?
It's been a while. It's been
forget,
pretty much most
yeah.
of the year, pretty much the whole year.
Yeah, and then going into from last year to as well, you picked that up as well. I mean, more months than you can count, essentially, right? Well over a year. So now we look at bonds, right? We're in month what? We're in half a month of risk off. I'm not saying it's going to last 2-3 years. That's not my implication, but the idea is that I wouldn't be surprised if we see a prolonged risk off environment here as the Fed tries to figure out the employment situation and we straighten things out. Ultimately, though, if risk does flip back on and equities do stay or go bullish trend, risk off out the window, risk on back, ride the wave higher. That's simply how we approach things. And I hope you guys enjoyed this podcast. If you have any questions, feel free to reach out to us on X at The Market Radar or go to our website at market-radar.com.